Okay. No? Sorry. Is that better? Yeah. Okay. So today what we're going to do is, now I'm too loud. Okay, so today what we're going to do actually is that better? Okay. Today what we're going to do is start on the second piece of this class. Okay? When I started, we talked about the three ways of doing valuation. Discounted cash flow valuation, which is pretty much what we've spent the last 15 sessions on. Relative valuation, where you basically value an asset based on how similar assets are priced, and option pricing approaches to valuation. I also said when I presented the three approaches that most valuations you see out there are relative valuations. You pick up an equity research report, you look at an acquisition valuation, what you will see is multiples and comparables, relative valuation. So what we're going to do over the next 5 or 6 sessions actually is hopefully going to demystify a lot of what you see out there as valuation. Let me start off by laying the table. Let me define what I mean by relative valuation. In relative valuation, you value an asset based on how similar assets are priced out there. Think about it. Most of the time when you try to decide what to pay for something, you base it on what other people are paying, right? You go to buy a house. You don't do an intrinsic valuation of a house. At least I've never seen anybody do an intrinsic valuation. You decide what to pay for a house based on what other people in the neighborhood have paid for their houses. You get on eBay. You're trying to buy tickets to the Yankee opening day. You don't say, let me do an intrinsic valuation of an opening day ticket. You look at what other people are paying for opening day tickets. You're pretty much there, right? What I'm trying to say is most of what we do in life in terms of valuation is relative valuation. And in fact, if you break a relative valuation down, there are the 3 basic steps. First, you have to come up with these comparable assets. With an opening day ticket, that's no-brainer, right? You look for other tickets around the same area. You're looking for a ticket. You're done. You have a Tiffany's lamp to sell, not a big deal. You look for other people selling Tiffany's lamps, and guess what? Right now, there's somebody else somewhere in the U.S. trying to sell something you're trying to sell. Okay? You can see how much more difficult it is to apply this concept when you're trying to value stock. Because what I'm trying to say is if you're trying to value Microsoft, all you have to do is find 10 other companies just like Microsoft, and that's going to be really difficult to do. So the first step here is you've got to subjectively determine what your comparable assets are. And you've got a strict definition of comparable. Second step, you get ready to compare prices when you realize prices per share are not comparable. You see why? If I use price per share as my measure of what's expensive, what's cheap, Berkshire Hathaway is the most expensive stock out there. Nobody should buy it. And there are penny stocks out there where you can buy a share for less than a penny, and they must be really cheap, right? But that makes no sense. Price per share is completely arbitrary. If I do a 2-for-1 stock split, I have the price. I do a 4-for-1 stock split, I make it 1/4. What did you? So it makes no sense to actually. Am I losing my? Sense. But the second step in this process, you cannot compare prices per share because price per share is completely arbitrary. So somehow we've got to standardize prices. Think about how we standardize prices. We divide the price by something, price by earnings, price by book, price by sales. When you see a multiple, what you're basically seeing is a standardized price. They're comparable, you get standardized prices. And then you start comparing the 15 companies you have equally. And you realize very quickly that they're not quite comparable. There's something off like this. One company is higher growth, the other is risk. These have a story. Comparable assets, standardized prices, set a story. That's pretty much what any typical equity research is. Now, when I said that most valuations are relative valuations, I might have sounded like I was exaggerating, but here's what I based it on. Now, in 2001, 2002, I collected about 550 equity research reports from around the world. Different investment banks, different equity research houses. I must confess, I didn't read most of them, but here's what I tried to do. I tried to categorize how different equity research analysts approach valuation. 550 reports. There were 45 discounted cash flow vendors, less than 10% of discounted cash flow. There were 450 relative valuations, most of them incomparable. 450 plus 45 is 495. What about the other 55? The other 55 I couldn't quite categorize. Scary, to be quite honest. They were equity research analysts in search of inner self, whatever it was. It wasn't really valuation. It was like a psychological exercise. But among the ones I could categorize, 10 to 1, relative valuations are my favorite. I said, maybe it's this. So I took a look at acquisition valuation. There it was actually much more difficult to get my hands on valuation. You know what? Investment banks hate to let those valuations out of their hands. So then you can see how much they screwed up. So in a sense, that's very difficult to get your hands on, but I tapped into my sources and I got about 50 acquisition valuations. There it was about 50-50. Half discounted cash flow valuation, half relative valuation. But even the half that claimed to be discounted cash flow valuations were often relative valuations in drag. You know what I mean, right? What's the biggest number in a DCF valuation? That's terminal value. The terminal value came from using a 6 times EBITDA, 7 times EBITDA, based on what other companies do. Those were relative valuations. Almost every rule of thumb you see out there is based on a multiple. You know the rules of thumb I'm talking about? Stock trades at PE less than 8, it must be cheap. A price to book ratio less than 1, it must be cheap. Peg ratio less than 1, it must be cheap. I don't know who comes up with these rules of thumb, but they've got them floating around, all based on multiples. So when people leave my classroom, about 70% pick discounted cash flow valuation, 20% pick relative valuation.
That's, you know,
Is that better? Okay, that's good. Thank you. Okay, so 70% pick discount. I have to remember to talk a little softer now, right? 70% pick discounted cash flow valuation, 20% pick relative valuation. I haven't done a follow-up survey, but I'd wager that if I track these people down 5 years later to wherever they're working and ask them the same question, the numbers would get flipped. So I started thinking, what happens between the time people leave my classroom and when they start working that makes them go from being true believers in intrinsic and discounted cash flow valuation to kind of users of relative valuation? Because clearly something happens on the desk to make people go from being DCF purists to relative valuation users. And I've come up with 3 reasons, and you're welcome to add to this list. Here's the first reason why I think people like to use multiples. It came to me while I was watching a Seinfeld episode. One of those episodes with Seinfeld's girlfriend, one of his girlfriends accuses Seinfeld of being crazy. He says, Jerry, you're crazy. And he says, if you think I'm crazy, you should see the guy who lives across the hall from me. Talking, of course, about Kramer, relative to Kramer. Who's crazy, right? That cuts to the heart of relative valuation. We forget of how much of valuation is selling. We think of valuation as number crunching and analysis, but a lot of valuation is selling. Selling to your colleagues, selling to your boss, selling to clients. It is much more difficult to sell a discounted cash flow valuation than a relative valuation. Let me try. I think Amgen is undervalued. Let me explain why I think it's undervalued. I used a return on capital of 16% and a reinvestment rate of 60% for the next 5 years. I got a growth rate of 9.6%. After the 5th year, I lowered the return on capital from 16 down to 12%. Lowered. By this time, you've hung up the phone and moved on, right? Who has the time for this at 8:30 in the morning? So let me try a different sales pitch on you. Amgen looks cheap. It's trading at 15 times earnings. Every other pharmaceutical company trades at 25 times earnings. End of story. You give me a multiple. You allow me to pick the comparables. I can pretty much sell you whatever I want, right? You have a cholesterol of 300? It's not too bad. Relative people have died of heart attacks in the last week. You look really good. You pick the right comparison. It works, right? So valuation is easier to sell if it's a relative valuation. Second, it's much easier to defend a relative valuation than a discounted cash flow valuation. You do a discounted cash flow valuation. All your insights are out there for people to take apart, right? They don't like your growth rate. They don't like your beta. Why do you use 5 years? Why not 10 years? Why not this risk-free rate? Why not that risk premium? Everything you do is transparent. In contrast, think of this. Let's suppose I told you that I value the stock at 6 times EBITDA because that's what comparable companies trade at. Target is tiny, right? You don't like it, take it up with the market. That, in effect, is what I'm saying when I use a multiple. I'm saying, I am just the messenger here. 50 times revenues, you might think it's too high, but I'm just passing the message on. Don't pick on me. Much easier to defend. That's why we go to a roadshow. You see multiples kind of rule the roost. And here's the third reason. I firmly believe that in the long term, you're more likely to be right with intrinsic valuation than than relative valuation. I'll give you a rough sense. I think you're going to be right about 60% of the time with discounted cash flow valuation and maybe 52% of the time with relative. Even if you're good at it, about 52% of the time with relative valuation. But here's the catch. When you're wrong with discounted cash flow valuation, you're far more likely to be wrong alone than with relative valuation. See why that matters? If you're going to make a mistake, have plenty of company, because that way you can say, don't pick on me, we all screwed up. So all those bank analysts who lined up out there saying, we told you, it's okay, we all made the same mistake, don't pick on us now. So here's, I think, what drives people towards relative valuation. It's a survival instinct. If you want to survive on the street, you have to have lots of company when you make mistakes, and you're far more likely to have that company with relative valuation than with intrinsic valuation. So 20 years ago, when I started teaching this class, I used to try to talk people out of using multiples. I don't even try anymore. I'm going to assume that you will all go out there and use multiples from now through eternity, because that's going to be the nature of your job. In fact, the nature of the job is, even if you believe in intrinsic value, and that's your true belief, you will be forced to use relative value because there's a place for relative valuation in your arsenal. You're being asked to make a judgment about how a stock is priced given how other stocks are priced. So I'm not even going to try to talk you out of this process. What I'd like to do, though, in the next 5 or 6 sessions is talk about how to do this right. Because my problem with relative valuation is not that people do it, but that they often misuse multiples. They use it as a shortcut to push companies that should not be pushed, to value companies in ways they should not be valued. Let me set up the process. When we talk about relative valuation, I said you have to scale the price to something, scale the value to something. Generically, there are 4 groups of multiples you're going to see out there. And if you have read a lot of equity research, you can already start categorizing the multiples into the groups. The first group of multiples, the most common group, are earnings multiples. Most common of which, of course, is the PE ratio. But variations of that, price to cash earnings, EV to EBITDA, EV to operating income, all using different measures of earnings. The second group of multiples are book value multiples, where you compare the market price to what the accountant tells you the value of something is, right? Price to book, enterprise value to capital. In fact, there's a variation of this multiple called Tobin's Q. You know whether you've heard of it. James Tobin won the Nobel Prize, argued that you could come up with the replacement cost for a company. In other words, if you tried to replace all of the assets of this company from scratch today, what would it cost you? And compare the market value to it. That's called Tobin's Q. You could have revenue multiples. Price to sales, value to sales. Fastest growing multiple in use in the 1990s. Why? Desperation drives you up the income statement, right? Because you need a positive number in the denominator. You keep going until you hit a positive number. And guess what? The only number you're guaranteed to have positive is revenues. A lot of technology companies, a lot of young companies, people started moving up the income statement. And the last group of multiples I call sector-specific multiples. These are multiples that you can compute only for companies within a sector. Market value per cable subscriber. Cable companies do this all the time. Market value per kilowatt hour. I've seen that actually comparing power companies. Market value per website visitor. We talked about this with .com companies. They're sector specific because you can compute them for only one sector. I think they're extraordinarily dangerous numbers to work with for a very simple reason. I mean, one of the biggest problems in equity research is tunnel vision. You get caught up in a sector and you can't look outside the sector. If you use a sector multiple, after a while you can't tell whether it's high or low. $300 per website visitor. Is that high? Is that low? Who knows? Whereas if I ask you to pay 100 times revenues, you already know that's a pretty high number. I better come up with a good reason. So the first step when you look at an equity research report is look at the multiple and say, where would I put it? Earnings, book value, revenue, or sector specific. So here's what I'm going to try to do, try to make sure this process is done right. I'm going to set up a 4-step process for working with multiples. I'm going to describe that process today. I'm going to try to apply it on PE ratios today. And for the next 5 sessions, I'm going to bore you out of your wits by taking multiple after multiple and taking it through all 4 steps. By the time I get to the 4th multiple, you're going to say, he keeps doing the same thing over and over again. And that is intentional. I wanted to get to a point where when you look at a multiple, this becomes second nature. Here are the 4 steps. I'm going to start off by defining the multiple. You think you know PE? I think I know PE. We might be talking about 2 very different numbers. There are multiples out there where 3 different people might have 3 different definitions. I want to take the multiple apart and say, is this multiple make sense? Should we have been using it? Second, I'm going to describe the multiple. Sounds like a fancy thing to do, but you know what I'm going to do? I'm going to put up a histogram. You remember histograms in statistics? Basically, I'm going to count the number of companies, PE 0 to 4, 4 to 8, 8 to 12, put it on. For 2 reasons. One, it's going to give you a sense of what's high, what's low. Those rules of thumb might make no sense anymore. It'll also give you some red lights, warning signals to watch out for when you start thinking about what those distributions start to look like. Then I'm going to analyze the multiple. I'm going to argue that embedded in every multiple are all of the assumptions you're trying to run away from. About cash flows, growth, and risk. Those assumptions you make in discounted cash flow valuation, you're making the same assumptions when you use a multiple. You just don't realize you're making them. They're implicit rather than explicit. So I'm going to try to make them explicit. And then after I've defined, described, and analyzed, only then am I going to apply the multiple. I think the biggest problem we have when you see people using multiples, they're in such a hurry to apply the multiple. They don't want to define, they don't want to describe, they don't want to analyze. So they just want to jump and use the multiple. So let's start the process. When you look at a multiple, here are the 2 basic questions you need to answer. First question, is this multiple consistently defined? Let me explain what I mean by consistently defined. Every multiple has a numerator and a denominator, right? Here's the rule. If the numerator is an equity value, the denominator has to be an equity value as well. If the numerator is a firm or an operating asset value, the denominator has to be a firm or an operating asset value as well. It sounds abstract, right? So let's take a couple of multiples, pass them through the test. Price earnings ratio. Everybody's PE, right? What's in the numerator? Market value of equity? I'm sorry, I'm giving it away. Equity or firm? Price earnings. It's going to be equity value. Denominator is earnings per share. Equity or firm? Earnings per share is net income after debt payments divided by number of shares. So thank God for small blessings. The most widely used multiple in the world passes the test. Numerator is an equity value. Denominator is an equity value. EV to EBITDA. You've seen this, right? Especially we've seen a lot of equity research reports. What's in the numerator? What's enterprise value? What's the definition? Go through the full computation. What is it? Market value of equity. Plus they cheat and use book value of debt, but really they mean market value of debt minus cash, right? Roughly speaking, that's the market value of the operating assets of the company. It's market value of equity plus debt minus cash. In the denominator, you have earnings before interest, taxes, depreciation, and amortization. A measure I abhor, but a very rough measure of the operating cash flows from the assets, right? So earnings before. So numerator is an operating asset value. Denominator is an operating cash flow. At least in a very rough sense, it passes the test. What about price to EBITDA? This buzzing is getting on my nerves. What about price to EBITDA? The analyst invented this multiple should be tarred, feathered, and driven out of the fraternity if one exists. It's a horrible multiple. In fact, out of the 550 equity research reports I looked at, 7 used price to EBITDA. And one of them, I recognized the name. He actually had gone through this valuation class like 10 years ago. So I called him and I said, he said, who is this? I said, remember that valuation class you took 10 years ago? He said, vaguely. And I said, close. Okay? And I said, what the heck are you doing using price to EBITDA? It's not consistent. He says, no, I'm being consistent. I said, what do you mean you're being consistent? He says, I use price to EBITDA for all 15 companies in my sector. I said, that's a very strange definition of consistency. So then I asked him a follow-up question. I said, have you been noticing that companies with a lot of debt in your sector keep looking cheap? He says, yes, I have noticed that, but what's that got to do with anything? I said, this is why your recollections of the valuation class is so vague. Help him out. When you use price to EBITDA, why do companies with a lot of debt look cheap? What's in the numerator with price to EBITDA? Market value of equity, right? Let's play a little game. The company goes out, borrows 10 billion, buys back stock. What happens to the market value of equity? It's going to shrink by 10 billion. What happens to EBITDA? Nothing. It's earnings before interest, tax. You can borrow from now through eternity. EBITDA remains what it is. Companies with a lot of debt are always going to look cheap when you look at price to EBITDA. Now, before you start getting too much of a superiority complex relative to this guy, if you've used price to sales, you are guilty of the same sin, right? And you've seen price to sales used in a lot of companies because numerator is market value of equity, denominator is revenues. You know why people get away with it? The two sectors where price to sales ratios are used most often are technology and retail. In technology, how do they get away with that inconsistency? There's very little or no debt. So because there's no debt, using market value of equity as if it were the firm value does not make that much of a difference. So cash can. We'll talk about that later. With retailing, you used to be able to get away with it because everybody had roughly the same debt ratio. You didn't have unlevered retail firms and firms with a lot of debt, but that's changing as well. Now you have firms which are very highly levered, firms that are lightly levered. We're comparing price to sales ratios. So is it consistently defined? Follow-up question, is it estimated the same way for all 15 companies? Is it estimated uniformly? You know how difficult a test that is to be? With PE ratios, what I'm asking you. The numerator is a market price. What's in the denominator? Earnings per share. The question I'm asking you, is the earnings per share computed exactly the same way for all 15 companies? We used to think in the US we were home free on this one because we had the same accounting standards governing all 15 companies. But we've discovered in the last decade that you can have the same accounting standards governing 15 companies and different degrees of fidelity to those standards. I'll make a generic statement. Aggressive companies will always look cheap on a PE basis. You know what I mean by aggressive, right? These are the companies that don't break the accounting rules but push each one to its limit to report the highest earnings they can. Conservative companies always look expensive. It's actually a very tough test to meet is how do we make those earnings numbers match up across companies? So is it consistently defined? Is it uniformly estimated? Second step in the process. When did you take statistics? First semester? I'd wager most of you sold back that stats book. You didn't even wait for the school class to be over, right? You said, oh, thank God I'm done. I have some bad news for you. The skill you need in relative valuation is not finance, it's statistics. What's statistics designed to do? It's designed to make sense of large and contradictory data, right? That's why statistics is useful. What do we face in valuation? You have 9,500 companies that are priced out there. We're being pulled in 15,000 different directions. We're trying to make one judgment on a company. Statistics is tailor-made for relative valuation. In fact, if I had my druthers and I could redesign the statistics class, I wouldn't teach it, but I could redesign it. I would design it entirely around relative valuation. Think of how much more fun it would be if you were using regressions to make judgments on PE ratios rather than is your weight related to how much you eat or some other obscure statistic you might throw in as an example. So when we look at a multiple, here are the basic statistical questions we need to answer. Start with the standard ones. What's the average? What's the standard deviation? That's what we're always taught to answer. But don't stop there. I'm going to show you histograms, distributions of every multiple. And what you're going to see with histogram after histogram is none of them resemble that symmetric distribution we worship so much in both statistics and finance. What am I talking about? What's the distribution? Normal. No multiple can ever be normally distributed. Do you see why? For a number to be normally distributed, what's the range of the number have to be? It's got to go from minus infinity to plus infinity, right? Take PE ratios. What's the lowest value PE ratio can take? So at one end, you kind of cap the number, float the number at 0. What's the highest number a PE ratio can take? Who knows? 10,000, 15. In other words, all the outliers with multiples lie on the positive side, and on the negative side, you're floored at 0. I don't know what your statistics professor taught you, but I remember my first statistics class, and I was told if you have an asymmetric distribution, which is just a fancy way of saying your tail sticks out just on one side, don't ever trust the average. Do you see why? What's going to happen to your average? If all your outliers are big positive numbers, you have no negative outliers, your average is going to get pulled down. In fact, I was told trust the median. In fact, I think as a general rule, when people talk about multiple shit, they should stop talking about averages. I mean, how many times do you get a call from a broker saying, this stock looks cheap, it's trading at less than the average PE for the sector. You're just one question away from defanging his entire recommendation. Say, what's the median for the sector? Because who cares what the average is? The median is a more meaningful number because that's a number that separates 50% of the distribution. Here's the other thing to worry about with multiples. I said the lowest value of PE ratio could take is 0, right? But you get a lot of companies with PE ratios NA, NMF. When do you see not meaningful, not available for a PE ratio? What has to happen to the company? Anytime the earnings per share becomes negative, you can't compute a PE ratio. Right? So let's take an example. Let's suppose you're the biotech analyst. I feel sorry for you already. You want to compute the PE ratios for all 33 companies in your sector. Unfortunately, 28 of them are losing money. So off the top, you've lost 28 of your 33 firms. You have 5 firms for which you can compute PE ratios. Is that kosher to sample 5 out of 33? Yeah, fine, right? But what's wrong with the sample? You can sample as long as it's a random sample. This is definitely not a random sample. You've chosen the 5 largest, most mature companies in the sector, the Amgen, the Biogen, the 3 other companies. And you're asking me to extrapolate that number to the 28 other companies in the sector that might be much younger, much riskier, much higher growth than these companies. So the other thing you need to worry about with multiples is how many firms in your sample do you lose when you try to compute a multiple, and what kind of bias is that creating in your final results. One final thing, and this is something that's especially important in a year like this one, have some sense of history. You can get a PE ratio today, but at least get a sense of what it was 1 year ago, 2 years ago, 5 years ago, 10 years ago, because you're making a judgment for the long term. You don't want to base it on a number that you see on a particular day. So that's a describe. Third step in the process, analyze. Embedded in every multiple are all of the assumptions that drive a discounted cash flow valuation. In fact, here's a technique you're going to see me adopt over and over again. You give me an equity multiple, price-earnings ratios, price-to-book ratios, price-to-sales ratios. I'm going to go back to an equity discounted cash flow model. I'm going to use the dividend discount model, simplest equity valuation model you can think of. And then I'm going to do a little algebra, and I'm going to tell you what the variables are that drive the PE ratio. You give me a firm value multiple, I'm going to go back to a discounted cash flow model based on the firm, free cash flow of the firm, cost of capital, and growth rate, and I'm going to tell you the variables that drive EV to EBITDA, EV to EBIT, EV to sales. It sounds like rocket science, but it's very simple to do. At the end of the process, you should be able to say, these are the 3 variables, these are the 4 variables that determine this multiple, and you can see why that matters, right? For instance, I'll give you a preview. PE ratios, function of 3 variables, your expected growth in earnings per share, your cost of equity, your payout ratio. That's it. There's nothing else that should be in a PE ratio. Once you know what those 3 variables are, you're ready to actually contest anybody who comes to you and says, hey, this stock is cheap because its PE ratio is low. You say, what's its risk? What's its cost of equity? What's its growth rate? You might be able to figure out that it's cheap, or you might decide it's not so cheap. So you have to figure out what variables are that drive every multiple, and you can find those. Second, you got to tell me how, as those variables change, the multiple is going to change. Like, let me use the PE ratio example again. I said the 3 variables that drive PE ratio are cost of equity, growth in earnings per share, and payout ratio. Let's take one of those 3 variables, growth rates. Growth in PE. What's the conventional wisdom? Higher growth companies should have higher PEs or lower PEs? Higher PEs, holding everything else constant. Of course, we know holding everything else constant is a very difficult thing to do here. But let's suppose I gave you 2 companies. They have exactly the same risk and the same payout ratio. But company A has a growth rate of 20% and company B has a growth rate of 10%. So I'm going to ask you the easy question first. Everything else about them is the same. Company A has a 20% growth rate, company B has a 10% growth rate. Which one's going to have the higher PE? Company A, right? How much higher? Now do you see why that? See, if you cannot answer the second question, you're stuck. Basically, the question I'm saying is, if your growth rate is twice as high, will your PE ratio be twice as high, 1.5 times as high, 1.2 times as high? And if you don't have an answer to that, how are you going to compare companies with different growth rates? We have to be able to quantify the effects of these variables. So define, describe, analyze. Once you've done those, then get ready to apply. And here I want to revisit 2 basic assumptions we've made in relative valuation for a long time that I think are dangerous assumptions. When we talk about comparable firms, you pick up an equity research report for a software firm, and you look at what they call comparable firms. Come up with the comparable firms. They look at other software companies, utility company, other utility companies. We've been trapped into thinking comparable means other companies in the same sector, right? Let me argue that. I mean, I basically don't see why you have to be in the same sector. From a valuation perspective, you know what a comparable firm looks like? It has similar cash flow, similar growth, and similar risk. Nowhere in there is there a sector component. I see no reason why I cannot compare a software firm to a utility. You give me Microsoft to value. Rather than try to compare it to 15 other software companies that don't even remotely look like Microsoft, I'd much rather compare it to other companies that dominate their sectors, have big cash balances, big market caps, and large margins. Maybe that will give me a better comparison than sticking sector specific. So first, I want to revisit that notion of comparable and maybe expand it. Second, I want to stop the storytelling. There's too much storytelling in relative valuation. What I mean by that is you see an equity research report. This company has higher growth than this company. Because it has higher growth, it should trade at a higher PE. So far, we're on reasonable ground. Then say, well, it's okay that you pay 18 times earnings for this company. With no attempt made as to how much higher the PE has to be given the growth rate. It's not just enough to give me a sense of direction. You got to be able to say, is 18 times earnings a high enough number given the growth rate. So those are the 4 steps. As I said, we're going to take multiple after multiple and take it through these 4 steps. Okay. Yes? Here's the difference, though. With beta, I'm looking at one dimension, right? Risk. So that's why when I talked about comparable, I said other companies with similar risk. Here in valuation, you're looking at risk, cash flows, and growth rates, right? So all 3. And it's very difficult to find other companies, if you stay within the same sector, that have similar risk, similar cash flows, and similar growth. So with betas, we had a much narrower job to do. What is the risk of the company? And we were done. We didn't care about growth. We didn't care about the cash flows because those were side stories there. We estimated those numbers for our company. So with betas, then I think there's a reasonable argument that if you want to use sectors, you want to come up with a beta. That's fine. I can live with that. But when you use multiples, you're actually extrapolating not just the risk, but every other dimension of value to every other company in the sector. And that's why I said for Microsoft, I have no problem if you estimate a beta for Microsoft looking at software companies. But I have a problem if you say I should pay 15 times earnings or 25 times earnings for Microsoft because other software companies trade at that multiple of earnings. Okay? So we're going to start with the most widely used multiple in the world, PE ratio. Everybody knows what the PE ratio is, right? Even Anna Kournikova knows what the PE ratio is. You know who Anna Kournikova is? She masqueraded as a tennis player for like 10 years. Won nothing, but was in every commercial you could think of. So this was a 2001 or 2002 commercial. You can actually pull it up from online. It was a Charles Schwab commercial. And in the commercial, Anna Kournikova is playing somebody. Must have been an actress. She was actually winning. Okay? So they're playing, and in tennis, every 2 games you switch sides. So they're switching sides. And for whatever reason, in the middle of a tennis match, Anna Kournikova turns to whoever she's playing and says, price-earnings ratio is price divided by earnings per share. And then she started saying something about preferred dividend that went completely over my head. So I turned off the TV and I said, does Anna Kournikova know what the PE ratio is? Is that simple? I know the numerator is usually the current price. Unless, of course, you're one of these technical analysts gone crazy who likes moving averages. Have you ever run into these people? They love moving averages for everything. To which my response has always been, have you ever tried buying a stock at a moving average price? Call your broker and say, I'd like to buy the stock at a 52-week moving average price. He's going to call you back and say, are you crazy? Usually the numerator is the current price. It's the denominator that the game playing really begins, right? Let's think about the variations. You can divide price per share today by earnings per share in the most recent fiscal year. That's called current PE, right? Price per share by the earnings per share in the last 4 quarters, which is called trailing PE. You could divide price per share by expected earnings per share in the next 4 quarters, which is forward PE. You can divide price per share by earnings per share in the next fiscal year, which is also called forward PE, which is a little confusing. Or you can divide price per share by earnings per share in the year 2015, which is really forward PE. Why would you do that? Desperation again drives you to do strange things. Remember that biotech analyst? 33 companies, 28 of them were losing money, right? And PE ratio was the only tool he had. You know what he did, right? He projected out the earnings for every company till the earnings turned positive. Then he turned around and said, this stock looks cheap. It's trading at 7 times 2015 earnings. And while he's scratching his head, said, what do I do with it? He sells you the stock and moves on. It could be earnings per share before extraordinary items, after extraordinary items. This year, in fact, a lot of companies are reporting earnings per share before option expensing, after option expensing, because the management options are putting a dent in their earnings. It could be partially diluted, fully diluted, primary earnings per share. I mean, in fact, about 4 or 5 years ago, I sat down and I wrote out for Cisco 34 different PE ratios for Cisco at one point, depending on how I defined earnings. 34 different numbers, ranging from 29 to 62. Let's say you're trying to sell me Cisco. Which of those numbers are you going to latch on to show me Cisco is cheap? Oh, it's 29 times earnings. In fact, it's kind of funny sometimes to see a bullish analyst and a bearish analyst talking about a stock. They'll both throw a P ratio out. The numbers will not even be close to each other. Technically, each one is right, but they're using different measures of earnings to fit whatever story they're trying to sell. In fact, if I'd been making that Kournikova commercial, I'd have made the actress she was playing turn around and ask Anna, trailing earnings or forward earnings, Anna? Then we would have discovered whether Anna Kournikova really knows what the PE ratio is. My point is, when I talk about PE and you talk about PE ratios, we could be talking about 2 very different numbers. So when somebody asks me, what's a PE, it says, this stock is cheap, it's trading at a PE ratio of 8, I say, stop, before you go any further, what's your definition of PE? And they say, you're in finance, you don't know what the PE ratio is? Even Anna Kournikova knows what the PE ratio is. I say, okay, Anna might know, but I don't. Give me your definition of, at the risk of sounding stupid, do it, because you have no idea what they're talking about. Okay? Last week I was listening to one of the financial news channels, and somebody was saying Google was trading at 9 times earnings. So 9 times 2020 earnings? I mean, there's no way Google, even at the lowest stock price, is trading at anything below 16, 17, 18 times earnings. But because people have this discretion in what they put in the denominator, you can get all kinds of numbers. So is it consistently defined? So let's look at the so definitionally, PE ratios meet the test, though there are some issues you're going to run into, and we'll talk about this later, as to what exactly you want to use for earnings per share, primary, partially diluted, fully diluted. We'll come back and talk about that. Right? Let's look at the distribution. This isn't rocket science. What I do at the start of every year is I take every U.S. stock, I compute the PE ratio for the stock. So there are 7,500 companies in my sample. I use Value Line for my raw data. Then I take the 7,500 companies for which I computed the PE, and then I do a histogram. I just look at how many companies have PE. So this is the histogram from January 2009. So think of this as a post-crisis histogram. Remember what I said about symmetric distributions and asymmetric distributions? You can already see that, right? Peak to the left, tail to the right. In fact, I've artificially cut the tail off by taking all stocks with PE ratios greater than 100 and putting them into this last group. If I let the tail go, it's going to stick up. There's the asymmetric distribution. I have current PE, trailing PE, and forward PE all in the same distribution. Let's take a closer look at the numbers. Let's see how asymmetric this distribution is. Here are my January 2009 numbers. Let's start with current PE. The average PE across all U.S. stocks in January 2009 is almost 19. Listen, that's not too bad. I thought the market had crashed. But the average PE is very deceptive because there are stocks out there. In fact, the highest PE in January 2009 was 2,442. Actually, in January 2008, it was 15,126. So that must be one highly priced stock. Actually, what had happened is the earnings per share dropped to a fraction of a cent because the stock price was still up there. Your PE ratio can be 8,000, 10,000, 12,000. This average PE reflects the outliers. And in fact, if you look at the median PE in January 2009, it's 9.8. That's the first time it's been below 10 in 27 years. The median PE for U.S. stocks is now below 10, which means half of all U.S. stocks trade at less than 9.8 times earnings. Keep that in mind, because there are people still with rules of thumb that were developed, 2 years ago, 4 years ago, 5 years ago. I heard somebody the other day tell me that 12 times earnings was cheap. If only you looked at the distribution. 12 times earnings, 65% of all U.S. stocks trade at less than 12 times earnings now. That's one of the advantages of looking at the distribution. So the median PE is well below the average PE. How many companies did I say I had in my overall sample? About 7,000, 7,500? How come there are only 4,010 companies in my sample if I started with 6,871 to begin with? I've lost 2,700 firms plus because they had negative earnings per share. And that is not unusual. That's not a 2009 phenomenon. In the 20 years that I've actually kept track of this statistic, every single year I've lost 35 to 45% of my sample. In fact, 2009 still doesn't reflect the carnage you're going to see. 2010 is going to be the year you're going to see a lot more companies drop out, because that's the year because the current PE in January 2009 uses earnings from when? What's the most recent fiscal year? It's going to be 2007. That's why you don't see the drop-off you're going to see next year, because next year you're going to see 2008 earnings come in, and a lot more companies will have negative earnings. I wouldn't be surprised if I lost 50% of my sample in the process of computing PE. So there's the asymmetry, there's the bias. As I go from current PE to trailing PE to forward PE, I keep losing more firms. I go from 4,000 to 3,737 to 2,800. Why? Why do I lose another 1,400 firms or 1,300 firms going from current PE to forward PE? What's forward PE again? Price divided by expected earnings per share in the next 4 quarters, right? Expected by whom? There's no way I'm sitting down estimating earnings per share for the next 4 quarters for 7,000 firms. So what do I look for? I look for an analyst estimate of earnings. And guess what? Any company that's not tracked by analysts is out of my sample. We create bias in the most subtle ways, in the way we pick a multiple. You pick a multiple, you've already put bias into your process in terms of what multiple you picked. And you can see the loss of sample size as you go from for current to trailing to forward. Just to show you how much 2008 made a difference, the median PE 1 year ago was almost 18. That reflects 35, 40, 40%, 45% drop in the market you've seen. But it's still something you want to keep in mind as you think about rules of thumb that were developed in a very different market. Until about 7 years ago, I used to do this just for US stocks. Then I'd go to Brazil and I'd put this distribution up. And some Brazilian analyst would put up his hand and said, it doesn't look anything like that in Brazil. So how do you know? Well, I've been in this market 25 years. And I got sick and tired of these gut checks. Wow, it doesn't look anything like this. That I decided to start doing this across markets to see if, in fact, Brazil was in its own universe, where maybe it's symmetric distributions there. Here's the bottom line, though. January 2009, I did this distribution for the US. I did it for emerging markets. I did it for Japan. I did it for Europe. So this is all 4 markets in the same distribution. First, look at the distribution. They all look pretty similar, right? Peak to the left, tail to the right. I'm not saying there aren't differences across the markets. Clearly, the median PEs are different across markets. So the peak of the distribution is a little more to the right for Japan, a little more to the left for emerging markets. But here are the median PEs. In fact, we can already start laying the foundations for thinking about what it is that drives PEs. In January 2009, the market with the highest median PE was Japan. The market, or the group of markets, the lowest median PE, were the emerging markets. I think there's a good fundamental reason why you have that Japan on top and emerging markets at the bottom. Help me out. What is it that gives Japanese stocks higher median PE than the rest of the world? Your risk-free rate is 1%. You already start off. What do we say the 3 variables that drive the PE ratio are? Cost of equity, expected growth rate, and payout ratio, right? What goes into cost of equity? A risk-free rate and a risk premium. If you hold risk premiums even stable or constant across markets and you lower the risk-free rate, you're going to see that reflected as a higher PE. Reason Japan's on top, and it's been on top every single year for the last 30, as having the highest PE ratio. The interest rates are much lower. And why are emerging markets at the bottom? It could be an interest rate story, but more generally, it's probably a risk premium story. So already we can see interest rates matter, risk premiums matter when it comes to PE ratios, and you can see at least a ranking of the 4 groups reflecting that. But my basic theme is the distributional characteristics don't vary across markets, though the where your location, what your median values might be, might vary across markets. So define, describe, let's analyze. As I said, it's a fairly simple process I'm going to follow. You give me an equity multiple, I'm going to go back to an equity discounted cash flow model. The simplest equity discounted cash flow model that I can think of is the Gordon growth model, a stable growth dividend discount model. In the Gordon growth model, the value of the stock today, the expected dividend next year, divided by the cost of equity minus the growth rate. That's it. I'm going to divide both sides of that equation by earnings per share, which I'm allowed to do, right? Constant on both sides. If I divide price by earnings per share, I have the PE ratio on the left-hand side. If I divide dividends by earnings per share, I have the payout ratio. And because I need dividends next year, you see a 1 plus growth rate pop up in the numerator. The PE ratio for a stable growth dividend-paying firm is a function of the payout ratio, the cost of equity, and the growth rate. That's it. Now, we do know with dividends, one of the problems is companies don't always pay out what they can afford to in dividends. That's why we developed the free cash flow to equity as an alternative dividend. Think of that as a potential dividend. If I put in free cash flow to equity, the PE ratio for a stable growth firm is a function not of the actual payout ratio then, but the potential payout ratio, the cost of equity, and the growth rate. For a stable growth firm, you give me those 3 numbers, I can tell you what the PE ratio should be for that firm. In fact, if you ask what-if questions, already you can start to lay the foundations for why some companies should have high PE ratios and others shouldn't. Right? Other things remaining equal, the higher the growth rate of a firm, the higher the PE ratio should be. Go back to the equation, change the growth rate. You'll see as the growth rate goes up, the PE ratio will go up. Other things remaining equal, the higher the risk of the firm, it shows up through the cost of equity, the lower the PE ratio should be for a firm. And other things remaining equal, the higher the payout ratio for a firm, given the growth rate, keyword is given the growth rate, the higher the PE ratio will be for a firm. Do you see why? When I have a high payout ratio and I'm able to maintain high growth, then I'm delivering growth more efficiently. I have a higher return on equity. In fact, you can replace the word payout ratio there with return on equity, and you get exactly the same conclusion. The problem here is other things remaining equal are very difficult words to utter here, because when you talk about risky firms, they tend to have high growth. High risk goes with high growth and low payout. And that's, I think, the challenge we face when we use multiples, is things move in different directions. One leads you to have a higher P, the other leads you to have a lower P. You've got to make a judgment on what the net effect is going to be on your stock's PE ratio. So that's with a stable growth firm where you know the growth rate is. The reality, though, is if I come to you with a high growth firm, you can't use it in that equation. Why? Because the growth rate is going to be well above the risk-free rate, and that equation works only if you're in stable growth. So here's an expanded version of the model if you have high growth. I know this page looks a little intimidating, but it actually is a present value page. Right? So let's say you have a high growth company. You got dividends during the high growth phase, and you got a terminal price at the end, right? This equation actually is the present value of dividends during the high growth phase. That's the first term in the equation. The present value of a growing annuity plus the present value of the terminal price. So what I've done is I've taken what we usually write out in an Excel spreadsheet on 6 rows and 3 columns and written it out as an equation. Why write it out as an equation? Well, if I divide that, so that's the value of a stock if it's a high growth stock. Present value of dividends during the high growth period plus present value of the terminal price. If I divide that equation all the way through by earnings, I come up with a PE ratio for a high growth firm. PE ratio for a high growth firm is a function of 3 variables: the payout ratio, the cost of equity, and the expected growth rate. Do those sound familiar? Those are the exact same 3 variables we had with a stable growth firm. The only difference is you estimate them twice, once for the high growth phase, once for the stable growth phase. You know how useful this is? Now if I have 10 stages of growth, I still estimate only 3 variables. I just have to estimate them for each phase separately. So when you're trying to disentangle a multiple, start with that simple stable growth model. What you get as the variables will be the variables that extrapolate even if you make the model much more complex. When I wrote my first valuation book in '92, it was reviewed by somebody from Barron's. So an equity research analyst actually reviewed it in Barron's. So the review was actually pretty good. It was fairly positive. But towards the end of the book, he said, this book is full of obscure mathematical equations. And he was talking about this equation right here. We're in big trouble when present value equations have become obscure mathematical equations, but we deserve what we get, right? When the minute we put that PV button on your calculator, all was lost. In fact, I could do a quiz right now and ask you to write the equation for the present value of an annuity. I'll wager most of you wouldn't be able to write out the equation. Why? Because you have the payment at the end. I mean, who uses an equation anymore, right? But there is, it is nice to actually think in equation terms because it is compact. Rather than have it spread out over 3 columns and 2 rows, I have it in one equation. And here's the other reason I think it's useful to think at least in equation terms. What's one of the questions I want to know the answer to? As growth changes, how will the PE change, right? The 20% growth come. Go back to high school. High school calculus. Remember that class? I've given you the equation for the PE ratio. I want to figure out how the PE will change as growth changes. What am I asking you in a calculus class? I'm asking you for the first derivative of this equation. Don't worry, I'm not going to ask you to do it. Don't freak out. This will not be on the quiz. It could be the singular first derivative of this equation. In fact, if you've forgotten all of your calculus, here's my suggestion. Buy Mathematica. You heard of Mathematica? It's a great program. They have a student edition now, which you can get only as long as you're a student, so buy it now because it becomes very expensive afterwards. It's about $150. It's not cheap. But here's what Mathematica allows you to do. You can enter the equation into the program. It'll compute first derivatives, second derivatives. It'll do it for you. It'll even draw 3-dimensional graphs. You want to impress a client, graph out PE ratio against growth and cost of equity in one graph. Mathematica will do it for you. You'll have no idea what it's saying, but it'll be a really good-looking graph. I mean, you'll be falling into valleys, climbing over mountains. Who knows what it's saying? But hey, people will be impressed. I'm actually going to use this equation in a much more low-tech way. Okay? I'm going to take a hypothetical company, and I'm going to use this equation to come up with the PE ratio for a company, and then I'm going to ask what-if questions. Okay? So basically, if you look at the model, the variables that drive PE ratio don't change. So they go from 1 to 2 to 3 stages. But this equation now allows me to come up with a PE ratio for any high growth company. So here's my hypothetical company. It's in high growth. The growth rate is expected to be 25% a year for the next 5 years. During that 5-year period of high growth, the payout ratio is only 20%. Why? Because they need to reinvest to get that growth rate. So low payout ratio, high growth. That's pretty consistent. I'm going to assume a beta 1 in both periods, but once they get to stable growth, I'm going to drop the growth rate to 8%, and the payout ratio goes from 20 to 50%. So I have high growth for the next 5 years, stable growth past that. Low payout ratios for the next 5 years, high payout ratio thereafter. My cost of equity, I'm going to assume, is 11.5% in both periods. I did that just to keep things simple. So I come to you with this company and say, tell me what PE ratio I should pay for the company. What's the right PE ratio for the company? Well, I have the equation on the previous page. I go in and plug the numbers. 20% payout ratio, 25% growth, 11.5% cost of equity. That's a high growth period. Stable growth period, 50% payout ratio, 8% growth rate, 11.5% cost of equity. I plug in the numbers. So basically, I take the equation, plug in the growth rate and the payout ratios and the cost of equity in both periods. I come up with a PE ratio of 28.75 for this company. See, what does that tell me? Think of that as an intrinsic PE. You're saying, what the heck is an intrinsic PE? I've used a discounted cash flow model to actually come up with a PE, right? So if I did a dividend discount model valuation of this stock, I'm going to come up with a value per share that's 28.75 times earnings. It's a fair price earnings ratio to pay for this company given the fundamentals for the company. So let's say you believe me. You go out and you pay 28.75 times earnings for this company. That's a pretty high PE, right? I mean, right now the median PE is 9.8. I'm getting you to pay 3 times that number. What is it that's inducing you to pay that high PE? What is it about this company that's making the PE so high? A high growth rate, right? So let's say you buy this company, it's priced right today, and tomorrow you wake up to a nightmare scenario. What's your nightmare scenario with the growth company? You realize, so you wake up tomorrow and there's no growth. We know what's going to happen to the PE ratio. It's going to collapse. The nice thing about a hypothetical company is I can figure out how much it will collapse by just looking at what the growth rate is going to be over the next 5 years. So I held everything else constant, and I graphed out the PE ratio for the stock as a function of just the growth rate over the next 5 years. No surprises. As the growth increases over the next 5 years, the PE ratio goes up. You're saying, why are there 4 different columns? I looked at 4 interest rate scenarios. A 4% T-bond rate, a 6% T-bond rate, an 8% T-bond rate, 10% T-bond rate. Under every scenario, the price-earnings ratio increases as growth increases, decreases as growth decreases. But take a look at the graph, because I'm going to ask you a follow-up question about interest rates. Under every interest rate scenario, PE is sensitive to growth, right? But under which interest rate scenario, low or high, is my PE ratio most affected by changes in my expected growth rate? There's my low PE, the purple line. The green at the other end is my high, is the low interest rate scenario. The purple is the low interest rate scenario. The green at the other end is the high interest rate scenario. Where does it look like my PE ratio is more sensitive? Low interest rates or high interest rates? It looks like under low interest rates, my PE ratio moves a lot more, right? Why is that? What is it about interest rates that affects why my PE ratios move more or less with growth rates? What's the value of growth? It's all in the future, right? As interest rates go up, what happens to your value of growth? Collectively, it's going to come down. Let's take an extreme scenario. Let's say you were in Brazil in 1991. Interest rates were 5,500%. What's the value of growth when interest rates are 5,500%? 0. What if I surprise you and say, I'm going to have twice the growth you thought? You said, still 0. Half the growth, still 0. When interest rates get really high, growth becomes useless. Nobody pays for growth. Surprises about growth have less and less impact on your value. As interest rates get lower, the portion of your value that's due to growth becomes larger for any given growth rate. Surprises about that growth, therefore, have a much bigger impact on value. So mathematically, you can see what's happening. But let's make this real. Are we in a low interest rate environment right now or a high interest rate environment? You know what this graph is saying, right? We're in a low interest rate environment. Surprises about growth are going to have a much bigger impact on the stock price in this market than 5 years ago, 10 years ago, 20 years ago. Now ask yourself a follow-up question. How do you get these surprises about growth? You buy a growth company. How do you get that revelation? Or what form does that revelation take that you're going to have no growth? Do you get an angel in the middle of the night saying no growth for you? I hope not. It's usually in the form of an earnings announcement, right? The company comes out and says, you know what, we told you revenues would grow 30%, they grow only 3%. You know what this graph is saying? The effect of an earnings surprise. This is what you get in an earnings announcement. It will be much greater when interest rates are low than when interest rates are high. Here's the problem we face right now. We're in a low interest rate environment, and every earnings surprise we see is a negative earnings surprise. This is the worst of all possible combinations. Is when you have low interest rates and negative earnings surprises, your stock price is going to melt down on the smallest surprise. 3 cents off expectations, the stock price is going to melt down. What we have to hope and pray is interest rates stay low and earnings surprises start becoming positive. And they will, because expectations keep getting lower to the point they will get positive. And maybe we'll get the upside of a low interest rate environment, because right now we're not getting any of the upside. We're getting all of the downside of a low interest rate environment, at least in terms of what happens to PE ratios. So there is an advantage, even with a hypothetical, you can start drawing implications for investing and where you should invest. Here's the second what if I asked. What if instead of growing 5 years, I was able to grow 6 or 7 or 8 or 9 or 10? I mean, the length of the growth period. Here again, no surprises. Holding all else constant, longer my high growth period, the higher my PE. But again, I looked at 4 different growth scenarios. Growth rate of 25% the first 5 years, 20, 15, and 10. And the effect of increasing my growth period is far greater when I have a 20% growth rate than when I have a 10% growth rate. Mathematically, you can see why, right? If my growth rate is 10%, my stable growth rate is 8%, letting a company grow for longer has much less impact. But here's the real-world implication. If you go back to our DCF discussion about the length of the growth period, the key variable that determines this is the kind of competitive advantages your company has. To make that assessment, you need a lot of information on what your company does, what it does well, how much better it is than the competition. You know what this graph is saying? If you're working with a high growth company, you need to understand the competitive advantages of that company a lot more than if you're working with a low growth company. You're buying 3M or Procter & Gamble, you can afford to be sloppy about competitive advantages because they don't add that much to value. You're giving them a 5-year growth period and the growth rate is 8%. If you're working with a company where you're assuming 30, 40, 50% growth and a 10-year growth period, you better understand the competitive advantages a lot better because your value rides a lot more on getting those right. The irony, of course, is we have a lot more information on 3M than we do on Under Armour. We have a lot more information on the mature companies where we care the least and a lot less information on those growth companies where we care the most. Third variable, so basically I'm still staying with that hypothetical company, changing one variable at a time. So we change the growth rate in the high growth period, we change the length of the growth period, let's change beta. I used a beta of 1 in my default case, in my base case. I changed the beta. Again, no surprises. As my risk goes up, my PE ratios come down. But here again, I looked at 4 different growth scenarios. 8, 15, 20, and 25% growth in the first 5 years. Let's play a little what-if analysis here. Let's assume that you're my consultant, and I am a small technology company with a very high beta and a very high growth rate. In fact, let me put some numbers in. My beta is 2, and my growth rate is 20%. So where am I on this graph? A beta of 2, right there, right? So I'm trading at 7.5 times earnings, and I'm not happy. So I come to you for some advice. Say, look, I really want to increase my price-earnings ratio, and I can adopt one of 2 paths, and they're mutually exclusive. First one, I can go for more growth. In which case, where am I stuck on this graph as I go for more growth? I'm stuck right there, right, moving up and down. Or I can go for less risk, in which case I'm going to be moving across the graph. Looking at the graph, it seems to me that the payoff to going for less risk here is going to be far greater than trying to push for an extra 1% or 2% for growth. There are times in a growth company's life where it has to make that choice. To me, one of the big problems with managers of growth companies, they get so focused on growth, and just growth, They can't step back and ask the question, maybe now's not the time to go for the extra 2% growth. Maybe now's the time to retrench and go back for less risk. Remember the Amazon valuation I showed you? I think the one thing you got to give Jeff Bezos credit for is in 2001 he recognized that basic fact, that growth was not what he should be focusing on, that he should be focusing on surviving and reducing risk. And initially analysts jumped on him because he said, I'm not even going to try to grow next year. I'm just going to survive, make sure I survive. I'm going to borrow money, keep it as a cash balance, not invest it back in the business. But he would, I mean, in a sense, he might not have had this graph in front of him, but that's exactly what he was thinking of, is if by reducing risk, I can get a much bigger payoff, why should I take those resources and go for an extra 1 or 2% of growth? My advice to companies in this market, for instance, is survive first and worry about growth afterwards. If you're a growth company in this market, building up a cash balance might actually be a really good thing. You're giving up on growth, but in this market, what the market is paying for growth is so little, and what it's charging for risk is so high that the trade-off works in your favor. So when you look at the what-if questions, you can already see the pieces come into play. So we looked at beta, we looked at growth rate, we looked at the length of the growth rate. Last variable, I said, what if I can keep the growth fixed and change the payout ratio? Which effectively is the same thing as asking, what if I could have a higher return on equity for the same growth rate, right? Because remember, return on equity, growth, and payout ratio are all kind of connected together. Holding all else constant, as I increase my payout ratio / return on equity for a given growth rate, my price earnings ratios go up. So beta matters, growth rate matters, length of the growth period matters, return on equity matters. Here's one way that I want you to think about every multiple. I'm going to do this explicitly for PE ratios, but I'm going to let you work this out as we work down it on other multiples. If you think like an investor and you think about what will my perfect undervalued stock have as characteristics, this is the combination you're going to be looking for. You're an investor, right? You want a low PE or a high PE? You want the low PE because you want a cheap stock. You want low growth or high growth? You do not want anything that explains away the low PE, right? So you don't want low growth, you want high growth. So you want low PE, you want high growth. Low risk or high risk? You want low risk. You already see the pattern of what we're looking for here? Low PE, we want high growth, we want low risk. Low return on equity or high return on equity? So basically you want a firm with low PE, low risk, high return on equity, and high growth. You're saying, what chance do I have finding something like that? No harm looking. I mean, that's why we do relative valuation. There are 9,000 stocks out there. You're hoping for the bargain of the century. Odds are you will not find it, but you want to get as close as you can to that perfect undervalued company. Here's the other way to think about this. I'm a broker. I call you and say, this stock looks cheap. It's trading at 7 times earnings. You already have the list of 3 questions you need to ask me, right? What's the growth? What's the risk? What's the return on equity? End of story. 95% of cheap stocks will disappear off the radar the minute you ask those questions. I'm not saying stocks can't be cheap, but you got to pass them through the test. You're looking for an unusual mismatch. A stock that is trading at a low price with no good reasons why it's trading at a low price. And that's going to be 1 out of 100 stocks, not 90 out of 100 stocks. So the advantage of asking going through this process is not so much that you're interested in the algebra or doing the hypothetical company, but it gives you a sense of what you need to control for when you use a particular multiple, whether it's price earnings or price to book or price to sales or EV to EBITDA or EV to sales or any other variable. I'm going to do at least, so what I want you to do now is sit back, think about the variables that I've just given you for PE ratio, and I'm going to play a multitude of roles. I'm going to be a market strategist. I'm going to be an equity research analyst. I'm going to come at you with recommendations. And I'd like you to play devil's advocate based on what we've just said and tell me what I might have missed. Here's my first job. I'm a global manager. I move money across countries. Here are the price earnings ratios for the G8 countries. You can see who doesn't belong right off the top, right? But we won't mention it. Right? Actually, we will. Just clearly, so there's something wrong here, right? If you just compare in terms of PE ratios, we should take all our money and put them into Russian stocks. So what am I missing here? So that's my recommendation for you. Liquidate your entire holdings and send them to Russia. It looks really cheap. There's a risk story. I missed the risk story. That's the obvious reason. Japan, of course, looks the most expensive. There again, before I jump to that conclusion, what am I missing there? It's the interest rate effect. Low interest rates translate into higher PE ratios. So that was an easy one. Let's move up the ladder. I come to you with some emerging markets. This is an old example, but I've kind of stuck with it for an reason. So these are my PE ratios across markets. Again, I am a global strategist, very simplistic. I pick stocks based on what markets have low PEs and what markets have high PEs. At least based on the comparison, it looks like Turkey looks really cheap, right? In contrast, Chile looks really expensive, 25 times earnings. But to help you out here, I've added 3 more variables about these companies. I've put the level of nominal interest rates. This was in 2000. The real GDP growth and the country risk. You see why I put them in there? Holding all else constant, the higher the growth rate, the higher the PE ratio should be, right? Holding all else constant, the higher the interest rate, the lower the PE ratio should be. And holding all else constant, as I increase country risk, my PE ratio should decline. Don't even try to eyeball the data. It's going to make you dizzy. There's only a certain amount of numbers you can have. Remember that statistics book I said you should have bought back? Remember the chapter on multiple regressions? This is exactly what it was written for, right? What's the variable you're trying to explain? Price-earnings ratio. What are the 3 variables you're worried about? Interest rates, growth, and risk. I know there are a lot of sub-tests I have to meet, but let's do a very naive multiple regression. I took the PE ratios for the emerging markets, regressed them against the level of interest rates, the level of real growth, and the country risk measure. Incidentally, that country risk measure is the Economist every 6 months reports it, but they actually get it from a service. If you go online, you can get it's a numerical score. You're saying, why didn't you use country ratings? Why didn't I use country ratings? Because it's tough to run a regression against AAA, AA. I needed something numerical. So the nice thing about the country risk score is it's a number going from 0 to 100. Okay? I think last year, Iraq and Afghanistan were close to 100 and Singapore was 5. So it gives you a sense of where the numbers range. Okay? So that's a regression. R squared is 73%. That's a little overstated. I won't get too excited about it because it's a small sample, 3 variables. A couple of outliers can make the R squares look good. All the coefficients have the right signs, which actually is not guaranteed in a financial regression. You see what I mean by the right signs? Every 1% increase in interest rates lowers my PE ratio by 7.94. Every 1% increase in real growth in GDP increases my PE ratio by 154. See, that's a huge jump, but real GDP growth is also much more difficult to push up. And every increase of 1 unit in the country risk, remember it goes from 0 to 100, lowers my PE ratio by 0.116. Interest rates, growth rates, risk. Now, why am I doing this? Because I had the table of PE ratios, and I was worried about differences in interest rates, growth, and risk across these countries. I have a regression now, right? I can take this regression and plug in each company's interest rates, growth rates, and risk number into this regression and get a predicted PE for each country. That's exactly what I did. I took the PE ratio and I got a predicted PE. Rather than compare the PE ratios across markets where I'm not controlling for these differences, you know what I'm going to do? I'm going to compare the PE ratio for the market to the predicted PE for that market. Let's take Argentina. Actual PE is 14. Look pretty cheap. But you know what? After controlling for interest rates, growth, and risk, it should be trading at 13.57 times earnings, which makes it slightly overvalued. I do that for each market. Like based on this comparison, the markets that came out, I think, cheapest were, I think Turkey came out pretty cheap, not 12 times. Venezuela was vastly overvalued, 20 times earnings, should be at 15 times. But basically, looking for undervalued, looking for markets with a PE ratio is well below the predicted PE. The predicted PE is a controlled estimate. You're controlling for risk, you're controlling for growth. I know we made some very generic assumptions about linear relationships, not controlling for correlation across the variables. But that's, there are lots of techniques and statistics to clean up for that. So if you want to go down this road, there are ways we can control for these factors without just telling a story after the fact. Any questions? I did an update, February 2009, okay? And I'll let you kind of grapple with these numbers and see if they make sense. So these are the PE ratios for emerging markets in February 2009. Argentina is trading at 7.5 times earnings. Russia is still trading at 2.5 times, 3 times earnings. Venezuela is trading at 4.5. I mean, you can already, as you go country by country, start thinking about what it is about these countries that might keep PE ratios down. You're not trying to explain it all away, but you're saying, after looking at the variables, which markets look cheap. And you can already see obvious mispricings don't jump out at you. There's usually something big holding PE ratios down. The question you've got to ask yourself is it big enough to account for this PE ratio? Russia, for instance, what's holding the PE ratio down? Rather than risk generically, it's that what you thought was your company might become Putin's company next week, right? There's this, and in Venezuela and Russia, I think this is an issue that keeps PE ratios depressed. Is there is a cost to being successful in these countries. If you're too successful, you might actually lose the company. So you actually have to keep your success under the radar. Now, you don't want to make too much money. You don't want to attract too much attention, because if you attract too much attention, you make too much money, your equity might actually go down in value. So you can see what variables are that drive these PE ratios down. But again, I mean, these are just the broad numbers. You can do what I did in 2000 using the February 2009 numbers, but I'll let you kind of decide what variables you want to bring in now, because these are post-crisis numbers now for all the markets. What variables you want to control for. You're not constrained by traditional valuation techniques here. You can bring in whatever risk measure you think captures the things you worry about in these markets. Maybe it's the size of the financial services sector. Maybe it's the threat of nationalization. But bring it in and see if you can explain these differences. Okay? So we'll stop there. As I said, this will not be on the quiz. Okay? What I mean by this is these 30 pages. Okay? We will cover everything from growth rates all the way through DCF valuations. In fact, look at all 12 companies that we valued, because with each company we emphasize something different, right? Corporate governance, distress. So all of those issues are fair game, which means you have a huge area to cover in terms of things to worry about. But go back to basics when you're in doubt, because that will give you a way of resolving any questions you might have. Okay? I actually will be in Florida for the next 2 days. I would say I was going for extreme state emergencies. I'm actually going to see the Yankees in spring training. So I will think about you constantly while I'm at spring training, not. Now, but I will have my BlackBerry. In case you email me, I will get back to you as soon as I can. Okay?
Yeah. A couple of questions.